Good morning and welcome to today's morning report. Charles Fraser is on Wednesday the 17th of May with me, Richard Perry, market analyst at Hantech Markets. Looking at these markets, you've got a corrective outlook. This move has been driven by safe haven trading, really, on the back of these fears that Donald Trump, his presidency is sort of spiralling out of control. The prospect of impeachment is actually relatively serious now. The fact that the sacking of FBI Director Jim Comey has sort of opened up a bit of a can of worms for him, really. The fact that, according to Comey's notes of a meeting he had with Trump, Comey sort of suggested that he should. Trump suggested that the FBI should shelve the investigation into Michael Flynn, his former security advisor. So that doesn't look great, does it? And the markets are sort of increasingly questioning how this impacts on Trump's presidency, really, the sort of prospect of him getting anything done, really, despite the fact that obviously he's got all these huge promises. Can he deliver anything, really? Because the fact that he's being so widely discredited. So, safe haven trading has taken over. Now, what we are seeing is the dollar strongly lower, and that has become apparent due to the fact that Treasury yields are off. Treasury yields on the 2-year sharply now down below 1.30, which was sort of a bit of a watershed, really, over the last few months. As is 2.3% on the 10-year. 2.3% had been a key floor, so that is that's again doesn't look all that great for these Treasury yields as markets sort of flood back into US Treasuries, and the dollar is under pressure on the back of that. You're seeing equity markets under pressure. The VIX volatility has spiked higher as presumably as investors sort of look to cover their portfolios with buying puts. So markets are sort of under pressure now. And we're seeing yen strengthening, we're seeing gold strengthening, equity markets lower, dollar lower, just pretty much classic safe haven trading. So that is one of the key sort of drivers of moves today. Now we have got some data out today that is also playing a role potentially. We've had the UK employment data and wages. Now, employment fell to 4.6%. That continues to decline on unemployment. But also, we've seen average weekly earnings falling to 2.1%. From 2.2% and below expectation. Now that has the potential to put pressure on sterling to the downside, although at the moment, to be honest, sterling is rallying. But certainly the fact that real wage growth continues to decline in the UK, that's not great for the prospects of sterling going forward. But we also look forward to the Eurozone inflation, the final reading of Eurozone inflation, 1.9% on the headline, 1.2% on the core. Let me show you those. This is the headline. And core, if it comes through quickly, which I don't think it will. No, it won't. Okay, but yeah, headline inflation sort of still expected to hold up around 1.9%. So relatively okay on the Eurozone inflation final reading there. Eurozone inflation remains underneath target though, but it is making progress towards the ECB's target, but albeit slowly. That's at 10 o'clock. And then this afternoon we've got the EIA inventories report. Now we had the oil price falling away overnight due to the fact that the API inventories actually showed a surprise inventory build. Now the EIA crude oil stocks fell record levels last week. Lowest, biggest drawdown since December. So biggest drawdown of this 2017. And expected to have another drawdown of 2.5 million barrels. So that would be 6 weeks in a row of inventory drawdowns. So that would be helping to support oil to a certain extent, you would certainly argue. Certainly if the inventories again came in under that. But it'll be interesting to see how the market sort of plays this one out, because you're also looking at distillates and gasoline as well, which are both in drawdown expectation. So that's takes me to my chart today, which is the dollar Swiss. Now, Swissy is obviously a safe haven play, but look at the moves in the last few days. Swissy strengthening sharply against the dollar, and it's sort of didn't even. I mean, previously throughout 2017, it's consistently sort of used that parity level as a bit of a stopping point. Didn't even really pay any regard to that, or even the 99.50 level, which again has been a bit of a pivot. So the market just fell strongly yesterday and through that 98.50 level of support, which has been a key floor. The intraday levels of 98.12 that were seen in March obviously are still intact, and the market will be looking out for whether it closes below this 98.50 level. That would be the key breakdown. So that is your resistance today, 98.50, that we need to watch out for. 98.50, which is there, and it's not a million miles off sort of testing that level again, but it certainly looks as though this is another key moment for the Swissy, whether the support can sort of hold and maintain that, arguably I suppose, that range play that we've had in the last sort of few months really, range between 98.50 towards sort of 101. I suppose you could argue up towards 101.70, but generally speaking, the sort of what's that 250 tick range that we've had on the dollar Swissy. So yeah, that's under pressure to the downside, and if you sort of break that on a closing basis, then you're looking at the levels of 96.75, and possibly even that's that post-Trump spike low of 95.40. But certainly this has sort of mirror images of the euro dollar breaking out above 108.50 and holding that break. So if it does confirm this move below 98.50, then that would certainly reopen this downside, and could come under pressure in due course. So with that in mind, I wish you good luck in your trading today, and I will speak to you later. Thank you.